Hello and welcome. You're watching NDTV Profit and a special today on the basis of the RBI's Monetary Policy Committee meet. Now, the Monetary Policy Committee, as along expected lines, voted to keep the repo rate on a status quo, and the stance has also remained unchanged. Governor Das continued to sound cautious on the inflation outlook because of a slightly elevated food inflation print, though core inflation has continued to provide a sense of comfort. We're looking at a little bit of a Goldilocks here going forward, with the inflation trajectory expected to ease, while the forecast for growth for FY25 remains buoyant and optimistic at a solid 7%. Now, that's according to the RBI's projection. To share more of their insights and takeaways on today's policy, I'm joined by Radhika Rao and Tanvee Gupta Jain. Thank you so very much to both of you for taking time out for us today.
Thanks, Pallavi.
Tanvee, I'd like to begin with you. What were your quick takeaways? Is it safe to say that the policy was broadly along expected lines, or did you expect more measures, like a lot of market participants, on liquidity?
Sure. So, thank you. If you look at the policy, I will say largely on the rates and even on the stance, it was largely on expected lines. So there was definitely no surprises. What is interesting is that if you look into details, one, the RBI governor clearly said that the stance of withdrawal of accommodation should be seen in terms of two things. One is the incomplete transmission, and second is inflation ruling well above that 4% medium-term target. Other interesting thing was to look at that the real GDP growth projections. They are projecting at 7% plus 7% GDP growth for FY25. At UBS, we are somewhere between 6.5%. And if you look at the headline CPI inflation, I think that is largely where the consensus is right now at 4.5% because of assuming normal monsoons. But I think the biggest focus of today's policy was clearly on liquidity, because we were all hoping to hear more from the RBI on how the liquidity management is going to be. So, the couple of things which I, kind of infer from today's meeting. One, clearly, MPC is acknowledging that the system-wide liquidity, which has turned into deficit largely from September, because this is the first time since May of 2019 that we are seeing that liquidity in the system has been negative. And we also try to adjust this with government cash balances. So potential system liquidity is in surplus, but we adjust for that. But the problem is that if the government cash balances still remains elevated, it will lead to frictional liquidity mismatch in the Indian economy. So while RBI is saying that I remain nimble with regard to liquidity, I would say we do expect liquidity conditions to remain tight in the March quarter, largely because, one, there are advanced tax outflow which are due in March. And at the same time, we have normally seen, going back in history, that the currency in circulation generally picks up ahead of the general elections. But yes, I think if you ask my view going forward, I would say going into FY25, we do expect a change in policy stance towards neutral, likely in the June quarter. And at the same time, we do expect a shallow easing cycle by the RBI, possibly in the September quarter.
All right. Coming to you, Radhika, what were your quick takeaways?
Certainly, I think the statement as well as the stance, the stance extension, which is withdrawal of accommodation, I think largely were on expected lines in terms of the policy decision. I think the markets were looking for a couple of things, as were we. While they might not change the stance, we were waiting to see if their language would change, essentially that they would sound less hawkish. And I think what you saw from the governor is that essentially he's still very much inflation focused, that while he sees good things happening around the horizon in terms of Rabi crop being better than last year's levels, oil prices being choppy, but again, they haven't really gone up to the 90 kind of mark. It's still been around the $80 and usually below it, gives them some kind of comfort. But nonetheless, I think it still sounds a lot more hawkish than we would have anticipated, which essentially tells you that the market will basically reprice rate easing, policy easing expectations. And I think on the growth front, certainly we are around the 6.5 mark ourselves as well. So I think that 7% for fiscal 25 is certainly on the higher end of the consensus at this point. But I think when you read the subscript, the central bank is certainly counting on a few things. They're counting on the farm sector, farm output also faring better, in the coming year than the year that's gone by. They expect the other domestic demand indicators as well to continue firing. Essentially, the private capex continues to do well. The public capex does well, so private capex can be drawn in, as well as consumption does better. While they are also sounding a lot more positive on external trade, we would personally be a bit more cautious on that because global growth outcome this year might be weaker than it was in the past couple of years. So in all, I think the growth outcome, they're positive on the growth outcome. They're still quite cautious on how inflation is going. So given this mix, there is very little need to make a dovish turn at this point. And I think that is what showed through the comments. And on the currency, finally, they did mention that it's still quite market driven. And despite that, the volatility is very low. And if you see the price action, has been about the 80 to 80, 83, 20 kind of range in January and Feb so fast. And on the liquidity front, I think there was, I think the switch between what happened in January and what happened in February caught, I guess, markets, a bit surprised, essentially because when you saw them infusing money, you thought that that they would like to reduce the deficit and take it down to neutral. But by playing on the other side, which is to drain liquidity, they've essentially shown that it's going to be a two-way operation. And we haven't, so it is not necessary that they would take it back to neutral very fast, given their overall inflation, concern. And finally, on the transmission, I think that is quite interesting because even in the post-policy conference, the governor and his other team members also mentioned that, while the external linked benchmark rates, which is essentially, the way repo moves, those rates move as well. Those that in that gauge, the transmission had completely happened. But if I were to take MCLRs, for example, you've only seen something like 135 basis points to 165 basis points kind of change. And this is just depending on the tenor. So which is way less than what the repo has moved, which is at, 250 basis points. So they would, the indication seems to be they will stay where they are till they have very clear signs of inflation coming off. They will use, and they hope that at this time, in this duration, policy transmission kicks in at a much faster pace. Essentially, it's a nudge to the banks as well to transmit a lot more of the policy tightening that's happened at the headline level.
Okay, that's very concise, Radhika. Thank you so much for that. Tanvee, I do want to touch upon the external outlook for FY25. We do see a little bit of a cloudy outlook on the external front, despite in the Indian economy showing fairly strong signs of resilience and most high-frequency indicators and even the advanced estimates surprising a little bit on the upside. But I do want to understand how much can we expect the external outlook, how much of a risk can we expect the external outlook to pose, especially in the coming fiscal?
Absolutely. So if you look at our UBS estimate for global growth, we are actually seeing a 50 basis point slowdown in the global economy, largely led by China and US. Now, if I look at India's sensitivity to a slowdown in G2 GDP growth, so I would say India, Indonesia, and China, as per our analysis, are the low beta economies. And for India, the beta is less than 0.5. So it's not that India is decoupled, but if the rest of the world is slowing down, India will get affected. It's not immune, but the spillover impact will be a lot lesser than what you might see in other emerging market economies. So at this point, despite external headwinds, we were expecting Indian economy to grow at 6.5%. But in case the global economy surprises on an upside, because we are already seeing US data so far has been strong, and the rate cut expectation also in US has been getting pushed forward. In that case, I think there could be more upside to even global GDP forecast that could have some implications on India as well. But as of now, I think I really don't know what the RBI is projecting. But with their 7% headline GDP growth, definitely at the upper end of the consensus forecast, and we still at 6.5%. we really need to see is it something more optimistic global economic outlook, which RBI seems to be have priced in. So I would say India is not immune to global slowdown, but the spillover impact is a lot lesser in India because of our lower beta to global GDP growth slowdown.
Okay, got it. All right. Radhika, coming back to you, I do want to ask you a little bit more about the economy as we're seeing now. Like all of the past year, we've seen very mixed trends, especially coming in from the rural sector. Today's commentary appeared to indicate, and that's also been the case for a while now, there has been conversation about some kind of an improvement being seen on the rural front. And today's commentary was pretty much in line with that commentary. So what's your reading of the rural sector, and can we expect that to push up consumption as well overall?
So the rural sector, I mean, we track some of the high frequency numbers for the urban demand and rural demand. And what we have seen, at least in the past 8-9 months, is that there is quite a bit of divergence still in terms of how urban demand is doing, which is doing better than how the rural counterparts are doing. And I think that has got to do with the fact that, inflation was higher there. Of course, in terms of the impact of weak weather on, and when we speak rural, of course, we have to classify whether you're talking about farm rural or non-farm rural, right? Because the non-farm rural, which makes a bigger part of rural, also has backward linkages to the urban sector. So now the farm community in particular, certainly the fallout of the bad weather conditions has been much higher. Fortunately, Rabi crop is doing well. Reservoir levels are still catching up. But I think when you look forward, there are quite a few things that one needs to wait and watch. I think domestically we have to watch for how the monsoon pans. We will start getting in a couple of months early indication of what the southwest monsoon again is going to look like. I think El Nino is expected to at least last in the first half of the year. And at the same time, you will also know how commodity prices are faring. If we pan back to the budget, the interim budget, of course, which was tabled, a week back, what you saw in the contents there was that if I were to just add a few of the relevant ministries, to get an idea of how much of money was set aside for rural development, it was not very different from what it was in fiscal 24. And certain sections obviously didn't. Haven't been, are not expected to grow by much. And on the subsidy front as well, you've seen a lower allocation towards food. You've seen also lower allocation towards the subsidies, to the fertilizer subsidies as well. Now, these are all premised on the fact that global commodity prices will remain under control. Now, if that goes up, particularly gas or any of the related commodities, you would see a higher outlay required on the subsidies front as well. So net, I would think, yes, I think even when we look forward 12 months hence over the year fiscal 25, one does hope that rural demand catches up at a much faster pace, and bridges the gap with urban demand. And for that, we need not only domestic things to fall into place, but also globally some of the spillover risks to be under control. But insofar as, here and now is concerned, certainly that gap still remains, but it's narrower than it was in the 7-8 months previously.
So coming back to you, Tanvee, so today, another interesting aspect was that we saw Jayant R. Verma vote for a rate cut, and in continuation we've also seen a descent in stance. So what are you reading into that going forward? Can we expect a slight difference in opinion to gradually increase here on, even if we do not expect a rate cut right away in the next policy?
Absolutely. I think that was a very interesting observation that one MPC member actually went ahead and asked for a rate cut. I mean, we have not been saying any of the member asking for a cut in rates, right? And it was clearly a 5-1 policy stance. So if I look at going forward, I would say this divergence amongst MPC members could go up over the coming months. So if you look at our policy rate cut call as well as a stance call, at this point, I'm more inclined towards a June quarter stance change. And in September quarter, maybe a start of a rate cut cycle once the Fed pivot and we start seeing inflation, specifically in the September quarter, coming towards that RBI's medium-term target of 4%. And that gives it enough room for to go ahead with a 50 basis point shallow easing cycle. But as you rightly mentioned, this is the first time we saw a descent, and going further in the next policy, I would expect that the descent or the divergence amongst the MPC members to only go up from the current number which you saw.
Okay, all right. So Radhika, I do want to ask you the same question. When are you penciling in a change in stance as well as a rate cut?
It's certainly interesting that at least one of the policymakers already saw room to cut rates at this point. We essentially need justification for why there would be policy easing brought forward, and I think probably the reasoning is more to do with inflation at this point, that it's come off highs, though it was largely driven by food when we came from 7.4% back towards 5%. I think what you've seen in the global central banks as well, that they have spent a good part of the first month of 2024 essentially pushing back rate easing expectations that markets have really brought forward. They've been very dovish. You saw that in the US yields, for example. You saw that impact on dollar index as well. And since then, you've seen both actually bottom out and pick up again. So I think RBI is also in that, partly in that camp with today's comments. Seems to suggest that certainly they're not no hurry to ease. And if you look at, again, looking forward-looking view on fiscal 25, with inflation forecast at about 4.5%, and the policy rate at about 6.5%, it neatly leaves about 200 basis points, more than that, gap between the policy rate and the inflation. So at that point, I think there is sufficient justification to say that this kind of real rates, you could keep it at an average at about 125 basis points, and thus the room opens up to lower rates gradually. For us at this point, we do expect the Fed to move in the second half of the year, and I would think around the same time the RBI could move as well. We have about 75 basis points of cuts. And I think, again, when the room for real rates opens up, that's when they would tend to act. Because on the growth front, certainly the numbers today seem to suggest that they're very, very positive on growth. And with a 7% growth forecast, that there's no growth-driven risk which they need to respond to. So from that angle as well, I don't think there's any urgency to take a very dovish pivot in our. But of course, before they actually cut, there'll be a few more changes that will be held. We think we'll get clarity on the liquidity stance, which is whether they would like to hold it near neutral or in a small deficit. Thereafter comes the stance change. I think if markets were anticipating a stance change in April, now it looks closer to it's in June, and then thereafter you would see a change on the rate front as well. But certainly, I think there is a lot more moves to be digested before we actually get to the cut per se.
Absolutely. Going by the commentary today, it's a long way before we see a rate cut per se from the RBI. But Tanvee, I also want some help in understanding. So, it's been a while since the conversation sort of shifted to when a rate cut will take place. But especially in case of India, we're not expecting a very deep rate cut cycle. It's expected to be a shallow cycle. And I kind of want to understand how you're looking at it vis-a-vis what the economy is looking like. We've seen the economy stay fairly resilient, and after today's commentary, the RBI also clearly holds that view. How much of a difference are we expecting the rate cuts to be able to make in FY25? How much of a fillip is it expected to give economic activity?
Very, very valid question. In fact, if you look at the real economic activity, when RBI themselves are projecting a 7% GDP, I mean, we are projecting a very Goldilocks scenario for India, 7% GDP growth and a 4.5% CPI inflation. Do we really need a rate cut when your bank credit remains quite robust? The bank credit growth is 16%. The gap between credit deposit, growth remains quite wide. The credit deposit ratio itself is close to an all-time high. I mean, even if I go ahead and start cutting rates tomorrow, can it really lead to any big fillip to the economic activity at this point when your domestic economic environment is actually very strong? So I think there are a lot of questions whether India really needs a rate cut, but we need to understand that what we look at past data, you realize that RBI never want to be an outlier. So if you see a Fed pivot and you see other EM central bankers following and start easing rates, I think RBI will also start cutting, but more as a signaling device, rather than really going there to boost economic growth, because the economic activity is very, very buoyant already. So I would say, if I look at the global backdrop, there will be a shallow easing cycle by the RBI, but more backdated rather than front loaded. Plus, at the same time, you really also need to understand what is happening on the credit deposit gap, because if RBI goes ahead and announces a 50 basis point cut in the policy rate and your credit growth is still sustaining in double digit levels, will there be any monetary transmission? Will the banks will have any inclination to cut deposit rates at a time when credit demand is very strong, or we will going to see that the credit demand in India comes down to be able to sustain the credit deposit mismatch? So I think there are a lot of things which RBI needs to take into account, but I would say, when RBI looks at the real policy rate and they look at 1 year forward inflation, and if the 1 year forward inflation is say at 4.5% and your repo rate is at 6.5%, you're calling for a real policy rate of 200 basis point. I mean, if you look at one of the recent reports by the RBI, they mentioned that they would like to keep the real policy rate somewhere around 0.75 to 1.25%, the range which used to be somewhere around 150 to 175 basis point 5 years back. In a scenario where we have contained macro stability risk, we definitely don't need real rates to be kept much higher, but definitely something which is more positive. For the household to save, and at the same time we are able to support the investment or the capex cycle. So I guess if you look at overall macro risk, while RBI is clearly highlighting that current account deficit remains under control, our government has went ahead and announced a much more much more aggressive fiscal consolidation. Where I think there is a concern coming right now is on the household balance sheet. As per our analysis, household savings are at a 25-year low, and household debt has gone up at a 15-year high. So at this point, a rate cut by the RBI also needs to balance whether it is going to boost investment on a sustainable basis, or it can lead to some more macro risk emerging because of consumption getting that support or nudge because of lower policy rate.
With that, we're out of time. Thank you so very much, Radhika and Tanvee, for taking time out for us today. Stay tuned to NDTV Profit for our continuing coverage.